Ever wondered why timing the market often leads to wealth destruction? Let's take a look at two investors. Picture this: March 2020, the stock market plummeted 34% in 33 days, the fastest crash in history. Two investors, let's call them Investor A and Investor B, each had $10,000. Investor A, driven by panic, sold everything. He decided to sit it out, wait for the market to recover before dipping his toes back in. He missed the market's bottom and bought back in 6 months later once the storm had seemingly passed. Investor B, on the other hand, did absolutely nothing. Yes, you heard that right. Nothing. He kept his automatic monthly investment running, buying more shares as the prices hit rock bottom. Fast forward 1 year later, Investor A, who reacted to the market's turmoil, was up 12%, not too shabby you might think. But then there's Investor B. He, who did nothing more than continue his automatic investment, was up a whopping 67%. The same starting amount, the same market conditions. Yet, one decision, or perhaps the lack thereof, resulted in a staggering 55% difference. This, my friends, is a tale of two investors. It's a story that illustrates the power of patience and the pitfalls of panic. It shows the potential of a strategy known as dollar cost averaging and the perils of trying to time the market. Investor B didn't predict the future. He didn't have insider information. He didn't get lucky. His success came from a disciplined approach to investing, one that didn't react to the market's ups and downs but stayed the course, buying more when prices were low and less when they were high. 1 year later, Investor A was up 12%, Investor B was up 67%, same starting amount, same market. One decision made a 55% difference. This is dollar cost averaging, and it is the single most powerful thing a regular investor can do. This strategy is as simple as it is effective. Here's how it works. Imagine you've decided to invest a fixed amount into the stock market every single month. Let's say that amount is $500. It doesn't matter what the market is doing, whether it's up, down, or sideways, you invest that same $500 consistently. Now, when the market is up and share prices are high, your $500 will buy fewer shares. But here's where the magic happens. When the market is down and share prices have fallen, your same $500 will buy more shares. Over time, this approach means that you'll buy more shares when they're cheap and fewer when they're expensive. You're automatically exploiting market fluctuations to your advantage without having to predict market movements or time your investments perfectly. This strategy allows you to turn market volatility into an ally rather than a foe. It takes the guesswork out of investing and replaces it with a disciplined, systematic approach. And the best part? It's all done automatically. You don't need to keep a constant eye on the market or agonize over when to buy or sell. By investing a fixed amount regularly, you apply a steady hand to the sometimes wild ride of the stock market. You create a sort of investment rhythm that smooths out the highs and lows. It's a strategy that can lead to significant wealth accumulation over time, and it's particularly effective for those who are investing for the long term, like retirement, where the goal is consistent growth rather than quick profits. Dollar cost averaging is a powerful tool for the regular investor. It's a method that leverages the inherent unpredictability of the market to your benefit, and it's a strategy that allows you to build wealth steadily and consistently, without thinking, without watching the market, without making a single decision. A 2022 study by Charles Schwab analyzed 5 investors over 20 years. This research delved into different investment approaches, providing insights into the effectiveness of each. The results? A telling narrative about the pitfalls of trying to time the market. One investor lunged in with a lump sum immediately. Another, the steady one, invested monthly without a second thought about timing. One brave soul attempted to perfectly time the market. Another tried the same but fell slightly off the mark. The last kept everything in cash. Now, who do you think came out on top? The perfect market timer, right? Well, yes, but only by a whisker. Just a hair's breadth ahead of our steady monthly investor. The difference was minuscule, barely noticeable. But let's take a look at the one who tried to time the market and missed it by a smidge. This investor significantly underperformed compared to the consistent monthly investor. That's right, they fell short. The attempt to time the market, to catch the highs and lows perfectly, resulted in a disappointing performance. And the investor who kept everything in cash? Well, they merely watched as their wealth eroded with inflation, an unfortunate bystander in the game of wealth creation. So, what does this all tell us? The story of these 5 investors is a stark reminder of the perils of trying to time the market. It's a high-stakes game, a gamble where the house usually wins. Consistent investing, on the other hand, is the tortoise in this race. It might not be flashy or exciting, but it's reliable. It's an approach that doesn't require you to predict the unpredictable or risk your hard-earned money on a hunch. Instead, it's about patience and persistence. It's about letting your money work for you month after month, year after year. It's about embracing the power of dollar-cost averaging and compound interest. The conclusion: trying to time the market costs you more than it gains you. So, why not take a leaf out of the Steady Investor's book, set it and forget it, let your money do the heavy lifting. After all, time in the market beats timing the market every single time. 3 mistakes that destroy this strategy. First, stopping during a crash. This is counterproductive. A market crash is a sale on shares. If possible, boost your contributions. Second, applying it to poor investments. Dollar-cost averaging shines with diversified funds you trust to rebound. Never apply it to individual risky stocks. Lastly, checking your portfolio daily. Markets fluctuate. Daily checks can lead to panic, selling at a loss, missing the recovery. At most, check monthly. Your action step today: log into Trading 212, set up a recurring monthly investment into VOO, choose any amount, set the date to your payday, confirm it, walk away. You have just automated your wealth building. Shoppen it siwi jar